Yesterday, the Economic Society of Australia Queensland Division hosted the new Deputy Governor of the Reserve Bank of Australia, Michele Bullock, and they had a Master of Ceremonies running this, and the Master of Ceremonies was me. So it's 3 years since we've hosted that lunch. The last one was at around about this time of the year with Governor Philip Lowe. The next one is in a year's time with Governor Philip Lowe. So it's good to be doing these presentations again, or participating in these presentations for the last couple of years. They've been virtual because of COVID. Very interestingly, it was the first in-person presentation to a room of people that Michele Bullock has done since becoming Deputy Governor in April. And we both talked about being a little out of practice with doing this, but it was very, very good. The presentation that she gave was really about very, very detailed research that the RBA had done to the risk of putting up interest rates by a significant level. And what she went through is the effects on different parts of the mortgage owning public, or the mortgage owing public, I guess, and what the damage would be for a significant increase in interest rates. And what the presentation showed is a very, very small percentage of people, maybe less than a few percent, that would be exposed to a negative effect on their home equity as a result of that. And what that really means is that the RBA is warming up the market and the Australian people for a significant increase in interest rates, and had gone out of their way to study the problem, show they'd studied the problem before they had actually acted, because no doubt as interest rates go up, as they will continue to do, there will be complaints about the levels of mortgage interest rates. Which then led to question and answer. And I had 3 prepared questions, 2 of which I asked. I always have one in reserve. The first one was about stable coins, because at a previous presentation, she had talked about stable coins. And the issue was, were stable coins at a level in which they could cause damage to the financial system, and they weren't, but she talked about increasing surveillance and regulation and such. Then I asked a question about quantitative easing. And this is where it started to get interesting for me, because what I said was, everybody asks questions about interest rates, but nobody ever asked about quantitative easing. And I said, well, if there's been research, or event research, it's called, by the Fed and the RBA, which shows that the effect of quantitative easing is actually quite small. That it's only the effect of putting up interest rates by 25 basis points. And she opened by saying that, by replying that, yeah, well, the RBA had done that kind of research too, and that's what they found. But then it became, what she said was, but what's important now is the quantitative easing is only really, really important at the lower bound, where there's a limit below which you cannot cut interest rates. But now we're in a situation where rates can go up significantly. And so what we need to look for is how far those rates are going up. And I didn't follow that reply up until much later, and then we threw to questions from the audience. And as we were coming to the end of questions from the audience, she introduced the subject of the neutral rate, and because the discussion of the neutral rate had emerged during the day as a result of the release of the RBA minutes. And the commentary in the RBA minutes was that rates had to go up significantly to get to the neutral rate. So in talking, she introduced the subject of the neutral rate, and she said that the neutral rate was actually a real rate. And that some years ago, a few years ago, the RBA had done a study of where the neutral rate should be, and the RBA concluded that the real rate should, neutral rate should be between 1 and 1.5%. And I'll come back to in a minute to the further conversations that I then had with her on that subject after question time finished. But when I looked up the article or the research that she was talking about an article that was published by the RBA in the Reserve Bank Bulletin in September 2017, and that article was called The Neutral Interest Rate, rather obviously, and it was by Rachel McCrick and Daniel Rees. And the conclusion that you get in this study is that the neutral rate is 1%, is the most recent calculation. The neutral rate is a real rate of 1%, for the short rate is where equilibrium is, and with an upper bound of 1.5%. So it's 1% with an upper bound of 1.5%. But what's really, really interesting to me is it's not what precisely it says in the research piece, but how the senior level of the RBA is thinking about this. So if the deputy has just said that she thinks that the neutral real rate is between 1 and 1.5%. So the question then was in my mind, what's the inflation rate? So after the presentation, when I was talking to her privately, I asked her the question, what's the inflation rate that you add to that real rate to get to where the RBA thinks that the neutral rate is? And she said, well, in the long term, we achieve an inflation rate of 2.5%. So I said, it's the neutral rate is 3.5%. And she nodded. But really what she's saying, to take literally what she's saying, is the RBA, senior level of the RBA, think the neutral rate for the Australian cash rate is between 3.5% and 4%. Okay. So when the RBA says that rates have to go up a lot further, they are thinking of rates going up to that neutral range between 3.5% and 4%. So that's very interesting because it's very similar to the results of the model I've been running of the Australian cash rate. So a couple of months ago, I suggested that interest rates would get to 3.7% next year. And I remember there was considerable shock. And I had lots of phone calls from people accusing me of wanting to put up interest rates. And I said, well, I'm just predicting it, you know. But what it seems is the model is giving us a pretty good estimate of where the RBA thinks that the neutral rate should be. Now the model is slightly higher now. It's about 20 basis points higher than it was a few months ago because unemployment has gone down. Now the model is saying 3.9%. So, but it's still in that range between 3.5% and 4%. So what I think is the RBA will continue to put up interest rates until they are sometime next year between 3.5% and 4%. And I've already forecast that I think that rates will be 335 basis points by the first week of November. So I think that the RBA will continue to raise rates to achieve that level sometime in the first half of next year. Are there any questions?